Hey there, rookie traders. Welcome to the exciting world of trading where the stakes are high and the rewards can be even higher. Ever scratched your head wondering how anyone can sell something they don't even own? It's a common question for beginners. Seems like financial voodoo, right? But don't worry, it's not magic. It's a strategy that can be mastered with a bit of understanding. Well, in the wild world of intraday trading on the NSE and BSE, it's a perfectly legal and potentially profitable maneuver. Traders use it to capitalize on market movements. It's called short selling, and it's like borrowing your neighbor's lawnmower, selling it, and then hoping to buy it back for less before they notice it's gone. Sounds tricky, right? Now, before you sprint off to raid your neighbor's garage, let's break down this intriguing trading strategy. It's important to understand the risks and rewards. Short selling might sound counterintuitive at first, but once you grasp the basic concept, it's really not that complicated. It's all about timing and market prediction. Stick with me and I'll walk you through it. We'll take it step by step so you can understand how to use this strategy effectively. Think of it like this. You're essentially betting against a stock. You're predicting that its value will decrease. You're predicting it's going to drop in price, so you're selling high with the hope of buying low later in the day. Timing is crucial here. If your prediction is right, you pocket the difference. Sounds simple enough, right? But remember, the market can be unpredictable. But remember, just like that lawnmower you borrowed, you've got to return the shares you sold by the end of the trading day. Timing and precision are key. Ready to learn how to pull off this daring trading feat? Let's dive in. Get ready to explore the ins and outs of short selling and become a savvy trader in the Indian stock market. Here's the gist of short selling in intraday trading, a strategy that can be both thrilling and risky. You borrow shares of a stock you believe is headed south, essentially betting against the stock's future performance. Then, you immediately sell those borrowed shares in the open market hoping to buy them back later at a lower price. Your hope? That the stock price drops as you predicted, allowing you to buy back the shares at a cheaper rate. If the price dips, you buy back the same number of shares at the lower price, making a profit from the difference. Finally, you return the shares to the lender, usually your broker, pocketing the difference between your selling and buying prices. This is where you see the fruits of your calculated risk. Presto! You just made money by selling something you never actually owned. It's like financial magic, but with real stakes. But wait, there's a catch. What if the stock price decides to take a trip to the moon instead of plummeting? This is where things get tricky. Well, you're on the hook to buy back those shares at a higher price, resulting in a loss. The higher the price goes, the more you lose. Remember, in the stock market, every trade has two sides, and there's always someone on the other end of your transaction. It's a zero-sum game. This inherent risk is what makes short selling a strategy best suited for experienced traders who can handle the heat. It's not for the faint-hearted. But don't worry, by the end of this essay, you'll have a much better understanding of whether short selling is the right move for you. We'll break down the complexities and help you decide if this high-risk, high-reward strategy fits your trading style. Let's say you're a bookworm, and you've got your finger on the pulse of the literary world, always in the know. You hear whispers that a highly anticipated novel is about to be exposed as a giant plagiarism scandal. You're certain the book's price is going to plummet once the news breaks, causing a market frenzy. This is your chance to put short selling into action and make a profit. You borrow the book from a friend, your broker, knowing they have plenty of copies available. Then, you immediately sell it to an eager reader at the current market price. The next day, the plagiarism scandal explodes all over the internet. Just as you predicted, the book's price plummets dramatically. You quickly buy back a copy at the lower price and return it to your friend. The difference in price? Pure profit in your pocket, easy money. This, my friends, is short selling in a nutshell. Of course, instead of books, we're talking about company stocks on the Indian stock market, but the principle remains the same: borrow, sell high, buy low, return, and profit. Now, let's translate this analogy into the real-life Indian stock market with a step-by-step guide to short selling. Short selling can be a powerful tool for investors who believe a stock is overvalued and poised for a decline. However, it requires careful planning and execution. 1. Identify your target. Choose a stock listed on the NSE or BSE that you believe is overpriced and likely to decline in value. This step is crucial because the success of your short selling strategy hinges on selecting the right stock. This requires thorough research, market analysis, and a dash of intuition. Look at the company's financial health, industry trends, and any news that might impact its stock price, such as quarterly results or regulatory changes. 2. Borrow the shares. Contact your broker and request to borrow the desired number of shares. Your broker will locate the shares for you to borrow, acting as the intermediary in this transaction. They act as the friend lending you the book. Just like borrowing a book, you must return the shares eventually. Keep in mind that borrowing shares comes with fees and interest, so factor that into your calculations. These costs can eat into your profits if not carefully managed. 3. Sell high. Once you've secured the borrowed shares, immediately sell them at the current market price. The goal here is to sell the shares at a high price, anticipating a drop in their value. Remember, time is money in intraday trading. The faster you can execute your trades, the better your chances of capitalizing on price movements. 4. Monitor the price. Keep a close eye on the stock's price movements throughout the trading day. Use real-time data and alerts to stay informed. This is where those real-time stock tracking apps come in handy. They provide instant updates and help you make timely decisions. 5. Buy low hopefully. If your prediction proves correct and the stock price drops, buy back the same number of shares at the lower price. This step is critical to lock in your gains. 6. Return the shares. Once you've bought back the shares, return them to your broker, effectively closing your short position. This completes the borrowing cycle. 7. Calculate your profit or loss. The difference between the selling price and the buying price, minus any borrowing fees and commissions, determines your profit or loss. This final step helps you understand the effectiveness of your strategy and informs future decisions.